You've seen the headlines. The Fed is cutting rates. So you check your mortgage app, and nothing's changed. If you're confused, you're not alone. Consumer confidence in housing has hit an all-time low. Why is there such a huge disconnect between the Fed and your wallet? Let's break it down.
Here's the truth. The Fed doesn't directly set your mortgage rate. The real driver? The 10-year Treasury yield.
The biggest myth is that the Fed directly controls your mortgage rate. They don't. While they influence short-term rates, your 30-year mortgage follows the 10-year Treasury yield. But there's a gap, a spread, and right now it's massive. This is the first reason your rate is so high, and the reason for that involves a hidden Fed lever. And with rates so high, millions of homeowners are trapped in place, locked into low mortgages they'll never give up. The supply of homes is frozen solid. These high rates have created a trap. Over 82% of homeowners have a rate far below today's average. Why would they ever sell? Economists call this the lock-in effect. We call it the golden handcuffs. It's freezing the market, crushing the supply of homes for sale. And this leads to the most surprising twist of all.
You've probably seen the headlines. The Fed is cutting rates. So you open up your mortgage app, you're expecting some good news, but what gives? Nothing's changed. Or maybe rates have even ticked up a little. If you're sitting there feeling totally confused by this, trust me, you are not alone. So today, we're going to get to the bottom of this mystery and figure out what is really going on. And look at this. This question, it's pulled right from Reddit, and it just perfectly captures the confusion. This is the exact question that millions of people, whether they're trying to buy a home or just thinking about refinancing, are asking themselves right now. And all this frustration, it's really putting a damper on the entire housing market.
Just how much of a damper? Well, get this. Consumer confidence has hit an all-time low. Only 17% of people think it's a good time to buy a house. 17! That's it! So what's causing this huge disconnect between what the Fed is doing and what's happening to your wallet? Okay, let's break it all down.
First up, we're going to tackle the single biggest myth, the biggest misconception out there about how your mortgage rate actually gets set. That's it. That's the big one. This is the crucial piece of the puzzle that honestly trips up so many of us. You see, while the Fed's decisions are, a big deal and they have a huge influence on the economy, they're not sitting in a room pulling the specific levers that control your 30-year fixed mortgage rate. The real driver is something else entirely.
So, this is what you need to know. On the left, you've got the Fed funds rate. Think of this as the interest rate for the big banks. It affects short-term stuff, like your credit card APR. But on the right, that's the one you really need to be watching, the 10-year Treasury yield. It's basically a measure of long-term confidence in the U.S. economy. And that is the true north, the real benchmark that 30-year mortgage rates follow.
But hang on, there's another wrinkle here. Even if that Treasury yield is, let's say, 4.5%, your mortgage quote might be over 6%. That gap between the two numbers, that's what the industry calls the spread. You can think of it as the lender's profit margin plus a little buffer for risk. And right now, that spread is unusually wide, which is another big reason why rates feel so high. So why is it so wide? Well, that brings us to the next piece of our investigation.
Okay, now we get to the really interesting stuff. It turns out the Fed has this other tool, kind of a hidden lever that has a much more direct impact on mortgage rates than those famous rate cuts. And it's all about something called MBS. Now, I know, mortgage-backed securities sound super complicated, but don't let the name freak you out. All it is a giant bundle of thousands of individual home loans, all packaged together and sold to investors like a bond. Now, during the pandemic, the Fed was a massive, and I mean massive, buyer of these things, and that demand helped push mortgage rates down to those crazy historic lows. But now the Fed's doing the complete opposite. It's in a phase called quantitative tightening. And in plain English, that just means as these old mortgages get paid off, the Fed is just letting that money vanish instead of using it to buy new MBS. This means there's less demand for MBS overall, which in turn forces lenders to offer higher rates to attract other investors. And that keeps that spread we just talked about really wide. So is there a fix? Well, the investment firm PIMCO laid out a pretty clear two-step plan. Step one is simple. Just stop shrinking. Take the $18 billion or so in MBS that are expiring every month and just reinvest it. Step two is a lot more aggressive. Actively start selling off some of the older MBS and use that cash to buy new ones. This would be like a direct injection of demand right back into the mortgage market. And check out the potential impact here. PIMCO figures that just by stopping the shrinkage, you could shave about 1/3 of a percentage point off mortgage rates. And if they got aggressive, we could be talking a full 0.5%. I mean, for anyone trying to buy a home, that's a huge deal. That's real money back in your pocket every single month. But these high rates aren't just hurting buyers, they're trapping sellers too.
And this brings us to a completely different, but just as important, problem that these high rates have created. A massive number of current homeowners are now, for all intents and purposes, trapped in their own homes.
Just look at this number from Redfin. It is absolutely mind-blowing. More than 82% of homeowners with a mortgage have a rate below 6%. Think about that. Why in the world would you sell your house, give up a 3 or 4% mortgage, just to buy a new one at 6 or 7%? The simple answer is, you wouldn't.
Now, economists have a term for this. They call it the lock-in effect. But I think a better way to think about it is as a pair of golden handcuffs. People are literally handcuffed to their homes, not by force, but by a financial deal that is just too sweet to give up. And this isn't just a theory. We can actually see it happening in the data.
Take a look at this data from a Federal Reserve study. It shows this lock-in effect perfectly. Let's start with the chart on the left. That line across the bottom is the rate gap, basically how much higher today's rates are than your current one. As that gap gets bigger, moving from left to right, look what happens to the blue dots. They plummet. That's the chance of someone moving within their own city just cratering. People are not making that local move to a bigger house anymore. But now look at the chart on the right. This shows moves to a different city. It's much less affected, probably because that's for a new job or a big life change you can't avoid. This proves it. The lock-in effect is freezing local housing markets solid.
So, this leads us to the final and, frankly, the most counterintuitive, most surprising twist in this entire story. It's the logical question, isn't it? I mean, it's basic supply and demand. If the supply of homes for sale just dries up, you would absolutely expect demand to fall off and prices to follow. But that is not what's been happening.
Okay, first, let's just confirm the supply issue. This chart shows active home listings. You can see for years it was pretty stable, but then look at that nosedive starting in 2022. That's the exact moment rates shot up and the lock-in effect grabbed hold. The supply of homes for sale was just completely choked off.
And here is the paradox. This chart tracks home prices. You'd think prices would go down with fewer homes on the market, but look what happens right after 2022. Just as the supply of listings vanished, the rate of price growth actually shot upwards. Fewer homes for sale somehow led to higher prices. What on earth is going on?
Here's the key. The lock-in effect doesn't just reduce the number of sellers. It also reduces the number of buyers because most people who sell a home also need to buy one. Now, in a normal market, that might cool things down. But in a seller's market, where you already have, say, 10 buyers fighting over 8 houses, if you take 4 sellers and 4 buyers out of the equation, you're now left with 6 buyers fighting over just 4 houses. The competition actually gets more intense, and that pushes prices up.
Okay, so let's put all the pieces of this very complicated puzzle together and talk about what this all means for the housing market right now.
So, to quickly recap what we've found. 1. Forget the Fed funds rate. The number you need to watch is the 10-year Treasury. 2. The Fed's hands-off approach to mortgage-backed securities is a big reason that spread is so wide and rates are so high. 3. The lock-in effect has put millions of homeowners in golden handcuffs, absolutely crushing the supply of available homes. And 4. The final twist. In an already competitive market, this lack of supply is paradoxically making things even more competitive and pushing prices even higher.
And all of this brings us to one final, really big question. You know, the whole idea of the housing ladder. You buy a starter home, build some equity, and then you move up to a bigger house. That's been the American dream for generations. But in a market like this one, where almost nobody can afford to move, has that ladder been pulled up for good? It's a really important question, and it changes the entire way we need to think about home ownership in this strange new world.
So the big question is, has the housing ladder, the very symbol of the American dream, been pulled up for good? Basic economics says low supply should lower prices. But here's the paradox. As listings vanished, prices soared. Why? Because the lock-in effect removes both sellers and the buyers they would become. In an already tight market, this makes competition for the few remaining homes even more fierce, driving prices higher. So, the American dream of trading up to a bigger home, has that ladder been pulled up for good?